Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Market Roundup, where we talk about the biggest moves in markets this week and what's driving them. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth, and as ever, I am joined by John Stepek, senior reporter at Bloomberg and author of the award-winning Money Distilled newsletter. I'd like to make it absolutely clear for people who've only joined us relatively recently that I too have many awards. Many awards.
Probably more, actually.
Yeah, I should hope so. I'm older than you. Yeah. Anyway. Well, listen, there's only one topic this week, John, and we haven't got long today, so we're just going to dive right into it. We are YOLO to Halo, right?
YOLO to Halo. This is great. Tell me what those, well, we know what YOLO stands for, but what does Halo stand for?
I've temporarily forgotten.
Okay, well, YOLO is you only live once, so buy...
And Halo is...
heavy assets.
Heavy assets, low obsolescence.
Yes.
Right, I wish they'd stop chucking this stuff out as endless acronyms. Anyway, this one comes from JP Morgan, I think, Halo, doesn't it?
I think so, although I read it
but
in
now
GavCal.
everyone is claiming it. Just like everyone, do you remember when we invented the phrase physical Bitcoin for gold? And next thing we knew, everyone was using it without it. Any attribution. Well, that's what's happening.
Should
to
have
that
copyrighted
nice
that
research
one.
analyst over at JP Morgan with Halo. So what's happening is that people are looking around and going, gosh, we're paying an awful lot for hope when it comes to things related to AI, software companies, et cetera, et cetera. We prefer not to pay so much for hope anymore. We prefer to pay for real stuff. So we're going to dump all that software and AI-related nonsense, and we're going to buy, mines, metals, any company that can show it's already invested in its infrastructure and that infrastructure is going to continue to work long term. Is that a reasonable summary?
Yeah, I think that is a reasonable summary. And I think it's interesting partly because it's the market really has latched onto this in the last month or so. Because first we had AI, Anthropic releasing all of those software products and really hitting some of the big names very, very hard. And then this weekend, a company called Citrini Research, who just do research notes, released sort of this apocalyptic, but basically sci-fi scenario about how AI could trigger an economic doom spiral. And certainly, regardless of whether it actually caused the sell-off or if it was something else, it certainly got the blame for a significant sell-off on Monday. So it sort of shows you how jittery everyone is about this.
I mean, I suppose it doesn't really matter in the end what sparks a sell-off, is it? I mean, if you have an environment where a particular group of stocks are very expensive, in the end, they'll stop being so expensive. And it can be triggered by pretty much anything under the sun. And maybe it was triggered by this note, maybe not. But, once everything becomes more emotional than fact-based, then this always happens. In the run-up to this, we've listened to endless stories about AI, which have been very positive. The spread of AI will increase productivity across the board. It'll increase everybody's earnings. It will add to the US dominance over global stock markets and the global knowledge economy, et cetera, et cetera. And now we find that, in fact, AI kind of eats itself a little. And so, in fact, when knowledge goes from being very expensive to, as a result of the evolution of AI, to going to be from very expensive to being either completely free or very cheap. Who wants to be in the knowledge economy? You don't want to be in the knowledge economy. You want to be in the the infrastructure and the real stuff economy that backs up the knowledge economy.
Yeah, and I guess that's the thing, because it's easier to, rather than worrying about picking the winners and losers, you just go straight for the things that aren't going to be affected or that are going to be affected because everyone needs more electricity, basically. And that makes a lot of sense. I mean, and that's a really good point with valuations, because I was looking just before we came on at, stocks like UK listed stocks like Experian and LSE and Relics that all got hit hard by the initial kind of software panic. And one of the things you sort of realise is that, they were all trading on PEs of, high 30s and 40s. And you're, they're now down to sort of like 20s, which is more reasonable-ish. But, those were very high multiples. So a lot of it is about people going, oh, hold on a minute, I'm paying, this might be a good company, but that is a hell of a lot to be paying for it anyway. So that point about this being an excuse as much as anything else is kind of very fair, I think.
So, John, it's partially about that. It's partially about this idea that if you've relied on expensive knowledge to support your valuation, and now knowledge may not be as valuable after all. It's partly that, but it's also about the shift from asset light to asset heavy, right? So we've always looked at these companies historically, Amazon, Google, Meta, etc., as being incredibly asset light companies. They don't have to spend big money to build an infrastructure to produce their product. That's not a thing. And so they've always been very, very high cash flow companies. And now they're looking around and going, well, actually, these are beginning to look like really sort of asset heavy companies. They've really got to invest in energy and power. And there's just a lot of money pouring into what comes behind the spread of AI. So we've gone from asset light to asset heavy, and you don't pay as much for asset heavy companies, and you don't pay as much for companies that are constantly having to invest as you do for companies that are simply cash flow machines.
Yeah, especially because this is speculative asset investment ultimately. It's one thing if BP turns around and says, all right, we found a load of oil, and if we spend this much and we get the oil out at this price, then we're going to make this much money. But these guys are saying, okay, there's an uncertain amount of AI required, and it's going to be of uncertain profitability, but we're still going to splurge $1 trillion on building the capacity because we're pretty sure that it's going to work out at some point. So that's the sort of future that I feel needs quite a high discount rate applied to it. And I think the market's kind of waking up to that. And then there is the deeper worry about, where's all this money coming from? And how much of it is in the private market rather than the public market. Obviously, that's not so much the case for the hyperscalers, but for all the kind of little companies that are on the side of this, a lot of them are raising money via private credit, or in various other ways. And it's not that clear how much of that there is, or where the choke points are, or where the vulnerabilities are, which is, yet another reason to be mildly kind of wary of what's going on there.
Do you think, John, this is also partly about interest rates?
I think it's very much about interest rates. A lot of it is about, I guess, the market still going through this wake-up process of having got used to being at 0% interest rates from 2010 up to 2021, starting to take that for granted and not quite realising that the normalisation in 2022 was permanent. We're not going back to 0%. I think it's taken a good few years for the market to start to really begin to acknowledge that and price it in. And actually, this is part of the process of pricing that in. In a higher interest rate environment, the hope stocks, the YOLO stocks, just aren't as attractive.
Yeah, it's just amazing how long this has taken, isn't it? I suppose I don't think either of us really believed that the transition period, the bit when people would go, actually, interest rates aren't going back to zero. They're going to knock around 3-4%, and I need to change the way I invest as a direct result of that. I thought that would be a 6-month process, but it's not. It's years.
I think it's partly. I think momentum's a really powerful factor, and I also think that the longer something's going on, the harder it is for people to change their minds. I think also it was happening in 2022, but then AI gave everyone an excuse to go back to the old way of thinking. And that is interesting because, when ChatGPT came out, it was cool. It could make up little poems for you and stuff like that, but it was very much kind of a toy. Whereas now it is really pretty impressive what it can do, even as someone who is, like, as I said, not skeptical, but hardly an early adopter. I can see the value in it. But of course, as that's gone on and it's evolved, it's also getting to the point where people are going, well, wait a minute, what if this destroys all of these businesses that we previously thought were either going to benefit from it, or use it to leverage their IP or whatever. So no, it's been a really interesting process, and all I can say is markets just aren't that efficient compared to what we might have thought.
I know we think they are and they aren't. Now listen, one more thing I wanted to point towards. There's a little report came to me today from Pamela Liberum about the thought of the day. And the question is, why do people invest in expensive stocks? Which I think you and I have talked about a lot. Why? Why do you invest in these expensive things? You can see they're expensive. You know what happens when you invest in expensive stuff, et cetera, et cetera. Anyway, he's written about this. Why is it that people continue to do this? And the answer is they like owning expensive stocks because they have lottery-like payoffs. They are fully aware the stock is expensive, but they invest in it anyway, because they think the share price will go up even further and no amount of data will convince them otherwise.
How's that a lottery-like payoff?
Well, because every now and then one of them will go up a lot more.
I feel that argument is used for everything. Like, it's used for why people invest in AIM stocks as well. And it makes more sense there because to me it's like, well, you get about a 1 in 1,000 chance of making any money and you're probably going to get shot, otherwise. But that doesn't sound like a good reason for buying.
So there's the reasons given. Perceived safety.
Yes, safety in numbers, definitely.
Yeah,
it's popular.
Perceived supremacy. I'm buying the best stocks. I'm buying the best stocks. Everyone, please see my column on that from last week. This does not work. But the majority of people say perceived lottery because it might go up a lot more.
That's
why the market is not efficient.
Yeah. I was wanting to read that study. I'll go and read that study in more detail because
I will send it to you. In fact, I'll tell you what. I will also pop it onto the show notes. I know we always say we do that. We often forget, but we're not going to forget today. We'll actually do that. Now, listen. This was always going to be a very short podcast, so I'm going to finish it there. But asking one question for you, John, before we close, based on this whole idea of moving from soft stuff to hard stuff. How many different metals do you think are required to make one server?
I'm going to just take a random guess at 12.
30.
30?
30. So why would you pay more? Why would you pay more for a share in a company that needs desperately to have those metals? Or the company that in an environment of relative supply shortage produces those metals?
I'm trying to think if I could even name 30 metals.
That's a different challenge.
I was just saying that.
I have not got time for you sitting there naming all the metals that you learnt about in chemistry at school today. That's not happening.
That'd make a great podcast. What are you talking about?
No, it totally wouldn't. But, challenge for listeners. Challenge for listeners. John, I'm going to close this now, but John is now going to sit here and think to himself about 30 metals. In fact, we'll do this together, John. We've got 5 minutes. But the rest of you, once I close this, think to yourself, how many metals can you name? How many metals can you name? It's really very important. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me at MerrynSW on X and John at John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Moses Andam and Summer Sadi. Now, we would be fascinated to know how many metals you can name without looking it up. So let us know on Twitter where you got to, and we will let you know where we got to.